Today is November 14th. In this episode, I'm going to review the latest earnings from two platform companies. One is Upstart, the other one is Walker Dunlop. The reason I call them platform companies is because they make money from transactions happening on their platforms. So the first one is Upstart. Upstart gave a pretty gloomy earning update as well as guidance. So we can see on the bottom right, quarterly revenue peaked at the beginning of this year at $310 million. Then it has been declining pretty rapidly. In the latest guidance, the fourth quarter revenue would be $135 million. That's significantly less than $300 million achieved in the fourth quarter last year. And that's because of the transaction volume has declined significantly. So in the third quarter, the volume was $1.85 billion. That's significantly less than the volumes in the prior 4 or 5 quarters. So for the full year, the guidance is now at $830 million of revenue, comparing to the initial guidance of $1.4 billion. So what caused the significant deterioration of the revenue and the guidance? That's because of the rapidly rising interest rate environment. So I'm going to get into details with the later slides. So just a quick update on the growth opportunities I identified during my initial deep dive. One issue related to the rising interest rate is the conversion rate has been dismal. So in the latest quarter, the conversion rate was less than 10%, comparing to over 20% in the previous several quarters, except the second quarter. So less than 10% is the lowest number in the recent 2 years. That's because of a higher rate makes a loan more expensive and less affordable. And also with the recession risk looming, and the risk premium has increased, and the lenders become more risk averse and make fewer borrowers eligible. The good news is that Upstart is still making good progress with its auto loan, although its auto loan volume guidance had been withdrawn. But if we look at the auto dealer penetrations, in the most recent quarter, there were more than 700 auto dealers using Upstart software. And that has built up a distribution channels for its loan product. So Upstart is laying the groundwork for future expansion in the auto loan business, which is significantly larger in terms of addressable market compared to the personal loan addressable market. Based on prior estimate, the auto loan TAM is almost 10 times larger than the TAM of a personal loan. Now let's move on to updates to threats and opportunities. As I identified before, Upstart may use its own fund to make loans, which create credit risk exposure. So at the end of third quarter, there were $700 million of loans on Upstart's book. That's more than 624 at the end of second quarter, but the pace of increase has slowed. Out of that $700 million of loan, about $250 million is because of a difficulty to sell to the asset-based security market. So that's a small portion out of $1.85 billion of a transaction. I'm not too concerned about the credit risk. Another risk is its business sensitivity to credit cycle and dollar supply due to the interest rate fluctuation. So you can see in the chart on the top right, the current forecast of in-period defaults has increased to about 25% higher than historical average. So there is a initial adjustment to the transaction volume because of that speed of increase. The lenders and the Upstart model were having trouble because of the very fast speed. If the interest rate stabilizes, then I think the risk can be more accurately addressed, and there is a chance that the transaction volume will pick up. Anyway, this is a new business cycle for Upstart, so I think it can come out ahead, but my conclusions were the same as before. Its business has a high risk and uncertainty. Looking at the valuation level, at $16 per share, its price over sales ratio is only 1.6, comparing to 5 for Equifax 5-year average. And and the price over sales was almost 14 at the end of 2020. So if it can grow its sales once the interest rate stabilizes, then I think there is still a potential that its total market cap may reach 100 billion, compared to less than 1.5 billion at the current price. Another way to think about its valuation potential is the company makes a FICO score has a market cap of 11 billion. So in a way, Upstart is making potentially more accurate assessment on credit risk that can be used to replace FICO score. Then there is a potential Upstart can get to the same market cap as FICO at 11 billion. That's 8 times from current market cap. So although there is a very high risk and uncertainty in terms of Upstart business, but there is no denial that it also has a very high potential return. I think its current stock price makes its current valuation attractive, but I just have to limit the size of my investment to take into account the very high risk and the uncertainty. Walker Dunlop also reported the third quarter earnings. Its transaction volume was down to 16.9 billion, lower than 1 year ago and also sequentially from the second quarter. Similarly, that's affected by the fast rising interest rate and investors holding back on transactions, waiting for the rate environment to stabilize. Its MSR asset was 121 billion at the end of September, comparing to 119 at the end of June. So basically holding steady. That's affected by the low transaction volume, especially related to the GSE. Its property sales volume was 5 billion in the third quarter, comparing to 5.2 billion 1 year ago. That actually outperformed the overall market because it was down by 17% year on year. So if we look at the different revenue streams, the loan origination and debt brokerage fee was $90 million. That's down sequentially as well as year on year. MSR revenue was 55 million, down from 89 million 1 year ago. The service fees came in around 76 million, increased about 10% from 1 year ago. And property sales commission 30 million, that's down about 10% from 1 year ago. The investment management fees increased to 16.3 million compared to about 2.5 million 1 year ago. That's because of the acquisition of aligned capital and the increase the asset under management. A big increase was in the escrow earning and other interest income for the amount of 18 million compared to 2 million 1 year ago. That's because of the direct beneficial effect from a rising interest rate and earning interest from the funds deposited in the escrow accounts. Other revenue was about $25 million compared to 19 1 year ago. That's driven by the Zellman and the Aligned acquisition. On the expenses side, the personnel expense was about 50% of revenue. The interest expense on corporate debt was 9.3 million compared to 1.8 1 year ago. That's driven by the additional debt to purchase aligned capital at the end of last year, and also affected by the rising interest rate. However, the escrow interest income is greater than the interest expense. The surplus is forecast to be more than $50 million in next year. Although a big portion of Walker Dunlop is a platform business and gets paid by transaction, the transaction volume has been down because of the rising interest rate. However, there is also a significant income from SAM segment, that's service and asset management. And that segment is fairly recession resilient. So in this table, I listed the segment revenue, operation margin, and EBITDA. We can see that in this year, the revenue has been fairly steady from second quarter to the third quarter, around $133 to $135 million. The operating margin is high, around 37%. The EBITDA is slightly over $100 million. So the increased revenue and the EBITDA from the 1 year ago, that's driven by the Aligned and the Zellman acquisitions, and as well as enhanced by the escrow interest income, as I mentioned previously. So if we look at the chart at the bottom right, forecasted escrow income will exceed the corporate debt expense by $55 to $70 million in next year. So because of the SAM business, so the Walker Dunlop's third quarter overall EBITDA was 75 million compared to 72 million 1 year ago. That's down from second quarter because of the impact from its transaction volume reduction. But it's still significant compared to 1 year ago. So as a result, the last year's EBITDA was $309 million, and this year's outlook will be increase of high single-digit growth. At the current stock price around $84 per share, its EV over this year's forecasted EBITDA will be about 12.7. I would say that's fairly attractively priced. Because of the abundant EBITDA generated, there will still be plenty of cash for share buybacks, paying out dividends, as well as paying interest and income tax. Also, it's worth noting that the Aligned and the Zellman acquisitions in last year has come in as planned at the time of acquisition. So that shows the management used the capital in a prudent way, because last year the real estate market was hot and they did not overpay for the two acquisitions. That gives me confidence in the management's future use of shareholders' capital. This concludes the latest episode of Quest for Twice. Until next time, happy investing.